Hello and welcome to our Q2 investment update for 2021. My name's Jordan Gillis and I'm once again joined by Michael Stimpson from our investment team, who's hopefully going to shed a little bit of light around what's been going on this quarter. So Mike, this has been a bit of a challenging quarter to get your head around, really. We've had market falls, market rallies, asset classes have not been doing perhaps what you'd expect them to. Inflation's been good, inflation's been bad. Can you help us sort of find our way through the turmoil and explain a little bit about what has actually been going on?
I can certainly try, Jordan. It's been a complicated quarter. You've touched on it there around inflation, and I think the big story of the quarter is markets have moved from focusing on infection rates and only worrying about the pandemic to a focus on inflation rates. And broadly, this is a good thing. It signals that we're moving out of the crisis mode that we've been in, where we're only worried about the pandemic, and we can start focusing on longer term drivers of markets. Specifically, what's happened is in May we had a big inflation number in the US. It was partly expected, but when a number above 5% comes in, it still causes everyone to sort of slightly hold their breath. It was the highest number we'd seen since 1993. And what that really did was it moved the focus onto the Federal Reserve meeting that happened in June. Would interest rates go up more quickly? How would they react? And broadly, they signaled exactly what I just said. We think we're moving out of the crisis into a more normal period of recovery. And what that means is that interest rates are likely to go up more quickly than was previously expected. That created sort of a little bit of a worry, a few jitters in the days surrounding the announcement. But actually, broadly, so far, I'm touching wood here, equity markets seem to have taken that news reasonably well and continued their sort of upward move.
And can I just ask a little bit about those jitters that you touched on there? Because I always find that an interesting dichotomy in that one sense, inflation is getting going again, and like you said, that's a great thing. We're coming out of a pandemic. This should be positive. But then on the other hand, if the Fed signals that they're going to raise rates, the markets sometimes wobble and worry about that. Which is it? Is it positive? Is it negative? Which one of those wins?
It's a good question, Jordan, and I don't think it's so much which one wins, but a question of how much. We all want inflation, some positive inflation, but not too much. We all want higher interest rates, but not to be in a situation where they're forced to go up too quickly. You and I may be too young to remember the inflation numbers in the 1970s, but there's definitely such thing as too much inflation. And so what we're trying to do here is walk the tightrope of, yes, it's good that we're recovering, but it means that we have to have a change in monetary policy. We need to have more tighter monetary conditions. And there's a question as to whether or not the economy is strong enough to handle that today.
Okay, and so if at the moment markets have sort of managed to take this news with as a reasonably good thing, does that mean equities have moved up? What's that meant for equity markets specifically?
So equities have continued to make progress overall at the headline level. Again, it hasn't been quite such plain sailing under the surface. If you remember 3 months ago, we talked about the rotation where some of the COVID winners from 2020 had performed much less well, and some of the companies that had really struggled had done much better. That has sort of reversed again in the second quarter. And so while equities overall have made progress, there's been quite a lot of whipsawing sentiment underneath the surface.
Okay. And in terms of, I suppose the one thing we should definitely touch on when you talk about inflation, normally everyone asks about what's been going on in the bond market. So, if inflation goes up, have we seen sort of big falls in the bond markets? What's been happening there, Mike?
Well, I think that is the most interesting question, because as you say, we would have expected this to be a more difficult environment for fixed income assets. But actually, particularly in the sort of last little bit of June, we've seen bonds rallying quite strongly, and we think there are a couple of reasons for this. The first one is that right now, as we sort of start to come out of lockdown, we're at the fastest stage of the recovery. So inflation numbers and growth numbers are the highest that the markets expect them to be. And so bond markets can slightly look through this noise and expect some of those numbers to come down through the second half of the year, and so not get too spooked by those numbers. But there's also a practical reason, and that's that the big institutional pension funds have found it really hard to buy fixed income assets for really quite a long time because they've been so expensive. And following a period of equity markets really going up quite well, some of those pension funds are in better positions from a funding point of view than they have been for a long time. Now that bonds offer a little bit more value, it's a good opportunity to balance out some of those risks. And so what we've seen is quite a few institutional flows into bond markets.
And has that also been slightly bad news for our alternative allocation as well, or has that had an impact on that?
I think the alternatives have been a mixed bag. The holdings of gold and gold miners haven't performed well. Gold's had another difficult period, but some of the strategies that benefit from volatility, such as convertible bond arbitrage or some of the macro strategies, have continued to perform quite well.
Okay, so pretty challenging environment to say the least over this last quarter. Asset classes have been moving all over the place, and it's been particularly difficult to find diversification. So what actually have we been doing in portfolios to respond to this and to go and find that diversification for clients?
Sure. So the first thing that we've done is actually what we talked about on the last video, which was to continue to broaden out that factor exposure in the equity portion of the portfolio. So we've added some deep value investments in Japan through the Nomura. Sorry, it's a bit of a mouthful. Nomura Japan Strategic Value Fund, and we've also added some value in the US equity market through the T. Rowe US Large Cap Value Fund as well. We've also added, for the first time in many, many years, some exposure to commodities through an ETF, which tracks the price of some hard and soft commodities. Again, just to get some more diversification, and because commodities, for the first time in a long time, look to be interesting value.
And what type of commodities are you touching on there, Mike? When you say commodities, that's obviously a very broad term for people.
So this is a broad-based commodity tracker, tracking hard commodities like metals and soft commodities like oil as well.
Okay. And so, with all the sort of seesawing that we discussed earlier, broadening out our factor exposure and adding some commodities, it sounds like we haven't sort of done a massive amount in portfolios. Should clients be concerned about that? Should we be reacting a little bit faster? Why is that?
It's a good question, Jordan. I think when you have changes of sentiment moving very, very quickly, you rarely benefit from trying to chase where the fast money's going. And what we have to do as an investment team is sit here today and not think about the next 1 week or 3 weeks or even 3 months or 6 months, but think about, what do we want the exposures to be for the next year, for the next 18 months, and try and build a portfolio that's well positioned on that basis. Because if you start trying to chase the value trade in the first quarter and then the rotation back in the second quarter, you can very quickly find yourself on the wrong side of every trade and then ended up whipsawing. And so, yes, we haven't been doing a huge amount of trading. Broadly, we think the portfolios are well positioned with the exposures that we've got today, and we're expecting to make money through the second half of this year.
Okay, and so with that in mind, then, where do we think the rest of the year is going? Are we in for this continuation of volatility and sort of inflation whipping around? And what actually do you think? Get your crystal ball out and tell us what's to come, Mike.
I think it's a really difficult question, Jordan. I know I'm starting to sound like a bit like a broken record here and saying we expect to continue to make money, but we think it's going to be difficult. But that is the answer. We think this volatility is going to continue, and actually, we've made pretty good returns in the first half of the year. In the second half of the year, we still expect to make money, although I think the strong equity market moves, equities have probably made most of the money that they're going to make for 2021 already. As we look forward, we're continuing to hold the inflation-proofed assets in the portfolio. That's index-linked bonds, that's gold. We're going to continue to hold the alternatives that benefit from volatility, the macro funds that I've talked about, convertible arbitrage. We expect to continue to add to the commodity tracker that we've put into the portfolio, again looking to try and broaden out that diversification even more, because we cannot rely on those global growth companies that have done so much of the heavy lifting of our portfolios, but also many other portfolios over the last sort of couple of years.
Okay, perfect. Well, look, Mike, I think you just about managed to shed light on the mayhem that we've seen this quarter. So thank you so much for joining me, and thank you as well for joining us. And we look forward to seeing you again at our next quarterly updates.
Thanks very much.